Ladies and gentlemen, good day and welcome to the Q3 and 9M FY26 earnings conference call of Juniper Hotels Limited, hosted by MUFG In Time India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. Certain statements disclosed in this presentation or that may be disclosed over this call may relate to company's growth prospects that are forward-looking statements within the meaning of applicable security laws and regulations. These forward-looking statements are not guarantees of future performance as they are subject to known and unknown risks which are beyond the control of the company. We have with us today Mr. Arun Saraf, Chairman and Managing Director, Mr. Varun Saraf, Chief Executive Officer, and Mr. Tarun Jaitley, the Chief Financial Officer. I now hand the conference over to Mr. Arun Saraf. Thank you, and over to you.
Thank you very much. Good afternoon, everyone. Thank you for joining us today. I am pleased to report a record performance of Juniper portfolio in Q3 financial year 26, with the company achieving its highest ever quarterly revenue of 300 crores. Strong sectorial tailwinds, healthy demand momentum in our markets, and rising ARRs are the key drivers during this quarter. Portfolio ARR grew by 9% year-on-year, while a disciplined focus on higher yielding segments and operational efficiencies has driven a 600 basis point expansion in EBITDA margin of 44%. Our F&B revenues grew by 25% year-on-year, driven by 39% rise in events during this quarter. Looking ahead, Juniper's strategy is centered on building a portfolio of high-quality luxury hospitality assets in markets where demand visibility, pricing power, long-term return potential are structuring a strong. Our focus is not on chasing short-term cycles, but on compounding value through disciplined capital allocation, asset quality, and operational excellence. Over time, we have been deliberately in aligning our growth with three clear pillars: presence in key gateway cities, early entry into high-potential emerging destinations, and strong bias towards luxury and upper upscale positioning. The progress we are seeing this quarter reinforces our belief that this strategy is well aligned with the structural shifts underway in India's travel and hospitality landscape. India remains one of the fastest growing economies, with GDP growth of 8.2% in July to September period. Rising disposable incomes, improving mobility, and young aspirational consumer base are steadily expanding the market for our premium experience-led travel. Domestic tourism has demonstrated sustained strength over past 5 years and accounted for 83.3% of the total travel and tourism expenditure in 2024. Fiscal measures and tax rationalization over recent years have supported household purchasing power, thereby shifting consumer preferences towards differentiated luxury experiences. This structural premiumization is the core theme of highlighting our long-term outlook and it directly supports our portfolio positioning. Public policy continues to play a conducive role. Government emphasis on connectivity, destination development, circuit for creation of circuits spanning heritage tourism, Buddhist circuits, eco-trails, medical tourism, skill development is gradually repositioning India from a high-volume tourism market to high-value one. Three initiatives combined with infrastructure investments are converting latent demand into sustained and more resilient travel flows. Recent trade developments, including India-EU Free Trade Agreement and the India-US trade deal are further expected to support demand push for hospitality sector and support increased business travel in India's key commercial centers and metros. Domestic air traffic for financial year 24-25 for the first 11 months reached 155 million passengers, up 7.7% from the previous year, 12.9% higher than pre-COVID levels. This is estimated to grow further by 7 to 10% in financial year 2026, reaching 175 to 180 million. Delhi, Mumbai, Bengaluru airports presently account for 47.5% of the air traffic share. Juniper has established presence in close proximity to these mega airports, with these three mega metro constituting 67% of the existing key count. The locational advantage typically translates into better occupancy visibility and higher utilization of premium MICE and event spaces. Indian hospitality market, valued at approximately 32 billion in 2023, is projected to grow at a CAGR of 9.4% by 2030. Industry demand is expected to grow at 9 to 10% CAGR, outpacing expected room supply conditions. This upcycle benefits the broader sector. The luxury segment will benefit disproportionately high. Luxury segment in the metro market is accounting for 76% of our revenues and is likely to see limited supply growth of less than 5% of CAGR up to 2030. The structural demand-supply imbalance is expected to support and drive sustained growth for Juniper portfolio, and is also an important cornerstone to our future growth strategy. While we focus on markets where infrastructure investment unlocks demand, but where asset differentiation and execution ultimately determine success. Let me now turn to our expansion pipeline and progress we are making across the key locations. In Bengaluru, Phase 1, 235 keys should commence operations in first quarter of financial year 27. And Phase 2 of 270 keys additional approvals are now being processed, and construction for Phase 2 is targeted to commence in financial year 27. Upon completion of Phase 2, the property will comprise of 508 big box hotel. The project is being developed with high capital efficiency at an approximate cost of 1.75 crores per key and is expected to generate strong ROCE. Bengaluru continues to be a core demand market for us, and is also one of the fastest growing markets in India. Our phased development approach allows us to capture existing demand while scaling capacity in line with market absorption, which aligns with our capital efficiency framework. In Kaziranga, for adding 111 keys, remain on track. This will be the first luxury offering in that market and is being developed in an eco-sensitive manner, representing our eco-luxury thesis. Premium, low-impact hospitality that integrates conservation, wildlife experience, and community engagement. In Guwahati, the process of getting approvals is underway. Construction is targeted to commence by quarter 2 of financial year 27 with 340 keys. Our planned hotel is designed to develop culturally rooted luxury, serving both business and long-stay experiential guests, and vibrant event demand. This fits squarely with our strategy of establishing early leadership positions in emerging premium markets. Guwahati is steadily emerging as a gateway to Northeast, benefiting from improved air and surface connectivity. Inauguration by Honorable Prime Minister of Terminal 2 at the existing Guwahati Airport in December 2025 with a designated capacity of 13.1 million passengers annually, has been nearly doubling throughout current throughput, thereby making Guwahati the largest aviation hub in Northeast India. Therefore, our developments in Kaziranga and Guwahati enable us to straddle the high growth potential of these markets. While Guwahati will benefit as a hub, destinations such as Kaziranga are likely to demand from experiential and eco-luxury stays. Beyond the projects currently underway, we continue to evaluate additional value-accretive opportunities. As previously shared, we have secured permission to add 314 keys at our existing flagship property, Grand Hyatt, Mumbai. Given the relatively lower incremental cost, the property's strong average room rate performance, this expansion offers the potential to enhance return on capital. We will commence work on this latent opportunity at the right time. We also hold two prime land parcels adjacent to Grand Hyatt, Mumbai. We are carefully evaluating the optimal development strategy for these sites to ensure effective monetization and long-term value creation in line with our disciplined approach to capital deployment. Juniper stands on a strong foundation with its core business exceptionally well positioned to capture both emerging and long-term growth opportunities in the sector. We continue to evaluate our assets and product offerings with a clear objective, that is to lead our competitive landscape. I will now hand over to Mr. Tarun Jaitley, our CFO, who will take you through the financial performance for this quarter. Thank you.
Thank you, Mr. Saraf. Good afternoon, everyone. I would like to now walk you through some of the key highlights of the quarter. As mentioned by Mr. Saraf, third quarter fiscal 26 has been indeed a record quarter for the company. We've achieved a revenue of 300 crores, reflecting a 15% YOY growth. The key drivers, as mentioned by Mr. Saraf, remain a very healthy ARR growth and a 300 basis points improvement in occupancy, room occupancy driven by Grand Hyatt. Average portfolio ARR stood at 12,818, while the average occupancy for the portfolio for the quarter was 78%. Our continued focus towards high-yielding customer segments, which are transient and groups, have contributed to ARR growth of a portfolio, outpacing respective city segment concepts. ARR growth for Grand Hyatt has been 7% YOY. Andaz has grown by another 10% YOY consistently, and Ahmedabad at 17% YOY growth in ARR is the star performer for the quarter. Grand Hyatt has been the key driver for occupancy during the quarter, as I said, with occupancies growing by 300 basis points on a year-on-year basis, and the Grand Hyatt occupancy achieved in Q3 was 75%. Across the portfolio, we continue to execute on focused strategy of exiting lower yielding contracts and reallocating capacity towards higher ARR and more profitable customer segments, which are transient and groups, and bridging the ARR concept gap. We continue to invest into our strategy of offering an upgraded and fresher product experience to our customers. Food and beverage revenues grew sharply by 25% year-on-year to 94 crores in quarter 3, accounting for 32% of the revenue compared to 30% in Q3 fiscal 25. This aligns with our continued focus on increasing F&B mix, given Hyatt's global strength is in F&B. Event segment at 64% share of F&B in quarter 3 was a key contributor with a 39% YOY growth. Events have again been primarily led. The driver for event growth has been Grand Hyatt during the quarter. Our standard annuity assets also performed consistently, contributing approximately 42 crores during the quarter, equivalent to nearly 1.9 times our finance cost for the quarter itself. This significantly de-risks our future business plans and growth. Robust ARR growth and improving cost efficiencies have resulted in a healthy 31% year-on growth in EBITDA to 132 crore. The margin for the quarter is 44%, which is a sharp 500 basis point improvement over the corresponding quarter. Importantly, for the 9-month period, Juniper has achieved an EBITDA of 306 crore and a EBITDA margin of 40%, something which we have been targeting to achieve and mentioned even in the last quarter call. On the cost front, we continue to benefit from higher flow-throughs of ARR, cluster-led cost efficiencies which have reduced our consumables and led to increase in F&B departmental profits during the quarter. Higher share of renewable energy in Andaz and Mumbai, and going forward we are also looking at implementing that in Lucknow and Ahmedabad. And that will continue to support the HLP costs contraction for the company as we go forward as a percentage of revenue. Finally, lower R&M costs during the quarter also supported operating margins. Profit before tax for the quarter increased to 83.5 crores, which is a 92% year-on-year growth during the quarter. And we have prudently provided for the impact of Labour Code 2025 and its resultant impact on gratuity provision of 6 crore during the quarter on a consolidated basis. The company continues to assess that, and we will see, based on the recommendation, what is the final position that we take, but we have done a prudent provision in the current quarter. The profit after tax for the quarter is 65 crores, represent 101% growth year-on-year, and the tax at 18.1 crore is being set off against brought forward losses, and therefore there is no cash flow impact of the same. For 9 months, Juniper achieved a PAT of 91.2 crores, which is a 459% YY growth. So this has indeed been a very, very landmark quarter for the company. On the balance sheet front, Juniper remains well capitalized. Net bank debt to EBITDA is 1.3 and the net bank debt stood at 569 crores. Our average cost of borrowing stands at 8.3%. And over the 9-month period, we have repaid 30 crores of term loans and also repaid down 88 crores of high-cost ECBs. Our cash position remains very healthy. We had, as of December 31st, 237 crores in cash. And on the growth front, which Mr. Saraf has already detailed earlier, we expect Bengaluru Phase 1 opening in Q1 fiscal 27. Kaziranga project is on track, and we expect CapEx for that to start to accrue from 4th quarter of this fiscal year itself. Bengaluru Phase 2 and Guwahati works are expected to commence by the first half of fiscal 27, with a potential 613 key addition by these two projects. Thank you. I now request the moderator to open the floor for question and answers.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Prashant Biyani from Elara Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, how is fourth quarter turning out, and how has it been till date? And based on business on books, how do you see the entire quarter?
So hi Prashant. So we continue to see firmness in the market, and we believe that the targets that we set out for the year for ourselves, I think we are pretty much on track to achieving them. So we don't see any significant slowdown in any market that we at least operate in.
Sure. Sir, is there any opportunity for further expansion in Hyatt Regency Ahmedabad?
So of course, I think Q4, as you know, is the strongest quarter for the sector, and we believe that there are certain operational efficiencies which are there, and Ahmedabad has only performed as per the optimal performance that it is expected to in this current quarter. And going forward, not only Ahmedabad, we anticipate all the other assets and the larger flagships also to continue to maintain, the optimal performance.
No, I meant capacity expansion.
So Ahmedabad is, after the demand undercurrent in Ahmedabad market continues to be very, very strong, and it has been so for the past few quarters. We do not see any sign of any weakness in that. A few quarters ago, there were times when Ahmedabad had 98% occupancy despite the expanded rooms. In this current quarter, Ahmedabad is at 85% occupancy.
And this is Arun here. And this will only strengthen given the way Ahmedabad is focusing on these global sports events with the Commonwealth Games already signed up, multiple international sports events happening. We believe that the Ahmedabad market demand will remain very strong with good ARRs and very, very high and healthy occupancy.
Sir, my question was, can we expand rooms further within Hyatt Regency Ahmedabad? Is there a room for that?
No. Sorry, I think we misunderstood your question. There is no further room for expansion or addition of rooms in Ahmedabad. That was done in the current complex, yeah.
Okay. Sir, we will continue with Marriott for the Bangalore asset, or what is the way forward?
See, Bangalore Marriott, we are in very detailed discussion with Marriott, and we will have something more to share in the future.
Okay. And sir, lastly, how much would be the hotel-wise occupancy for last year Q3? For this year, you have shared in the PPT. For last year, if you can share, it would be great.
I mean, we don't share, the hotel-wise numbers, Prashant. But we do share, the luxury and upper upscale segments, which is there in the presentation as well. If there are specific questions that you have, I'll be happy to answer that for you separately.
Okay, sir. That's it. Thank you so much.
Thank you. We have the next question from the line of Vaibhav M. from Haitong Securities. Please go ahead.
Hi, sir. Congratulations on a very strong set of numbers, and thanks for the opportunity. My first question was on our F&B performance. We have delivered a very strong growth of 25% year-on-year. Can you share more color on this, how we have achieved a strong F&B growth which has outpaced the overall room revenue growth as well for the quarter? That's my first question.
Right. So as I said in my introduction comments, right, F&B has been a good performance in the current quarter, but again, and this quarter it's been driven by Grand Hyatt, where the F&B in Grand Hyatt has grown by roughly around 23+%. So there is the Grand Hyatt has been a large contributor, followed by Ahmedabad on the F&B side.
Just to add to that, this is the first full season that you're seeing the showroom being operational. Last year it was there, the market was understanding that, and this is something that we built about 18 months ago, and this Q3 and Q4 is where the real impact of the showroom will be visible, and that's what you're seeing the initial signs of.
Yeah. And again, to come back to your question, F&B is a traditional strength for Hyatt, and we've put that as a focus area for us in the last few quarters, and we are happy to see that is now playing out. And F&B as a percentage of revenue should normally trend to around 33-34%. We are in the last quarter at around 31%. So there is still room for growth there.
So you think the growth is sustainable going forward in FY27 for F&B?
Yes, certainly.
All right, sir. My next question was on our Bangalore project. I think we have delayed the opening by 1 quarter, and earlier we were targeting Q4 FY26 opening. Now we have shifted it to Q1. Just wanted to understand why there has been a bit of delay over past quarters in operationalization of this asset. And secondly, what kind of EBITDA contribution do you expect from this asset in FY27 and 28? And what would be the expected timeline for this asset to scale up to an optimum level?
So there is no actual delay in the opening. Where we are today, the hotel is undergoing the final phases. There will be a soft opening. The approvals need to come in place. The brand needs to be finalized, and in Q1 of FY27, the hotel will start generating revenues. And in terms of overall first-year revenue, I will let Tarun sort of add on that.
Yeah, thank you, Varun. So just to add to what Varun said, if you remember, we've been sharing this with you, that we want to optimize, that important asset for us. It's a 500 and key asset, and it's a big one. And it is also, we acquired it in a partly developed stage, and the configuration of that asset is luxury plus segment, which is more fitting with our overall strategy. And we have been engaged with Marriott to give us a higher luxury flag than what it is right now. And those discussions are the only reason where this little bit of time is taken, and we believe it is worth that 1 or 2 months movement, given that we are able to get a better flag for that asset. That's the only reason. Otherwise, from a readiness for completion of the project, there is no delay. And yeah, so the approval is the only reason. Otherwise, there is really no delay in construction of that asset. So we're just doing justice to what that asset deserves. As far as the second bit of your question, again, I would refrain from really giving you specific projections, but I would say that in FY27, we are looking at this asset contributing positively to EBITDA upwards of 25 plus crores.
And for FY28, so what would be the range?
In FY28, on a stabilized basis, this asset should give you above 50-55 crores.
Understood, sir. Perfect. Thank you so much and all the best.
Thank you. We have the next question from the line of Samarth Goel from Choice Institutional Equities. Please go ahead.
Hello. Hi, all, and congratulations for the amazing result, and thank you for the opportunity. So my question was around the ROFO agreement. So the ROFO agreements, what I've understood, are part of Sara's group's promoter assets only. One is Hyatt Chennai, which is a robust hotel, and one is Hyatt Mumbai, which is an Asian East. So despite this promoter linkage, what are the specific factors causing delay in the stretching the timelines on ROFO acquisition and consolidation of these assets in Juniper?
So, Samarth, the ROFO mechanism is a broad mechanism, not really linked to any specific assets, but I'll come to the specifics that you asked. We have already gotten in the past year 2 companies, which is Chartered came in, it was sitting outside of Juniper, and then we also got in Kaziranga into Juniper to make Juniper as the flagship. So that's point number 1. With the named specific assets that you've spoken about, which are right now sitting outside of Juniper, these are all individually sitting in their own listed companies, and they have their own compliances and other issues. As and when we have something tangible in that mechanism to share with investors, we would, in the most transparent manner, share the same with you at that time.
Okay. Any timeline or any next milestones which are a hurdle right now?
Yeah, I would not wish to speculate on it, but I will, as and when there is some credible development that happens, we will share that in a most transparent manner with the investors.
Okay. There is another question related to your participation in the CIRP of Custard Hotels, the JW Marriott in Bangalore. Could you share any current status of the resolution process, and what's up? Is the bid still in Ventures' favor for this, or is it in Juniper's favor, or is it a dead end?
So we are one of the resolution applicants for the start resolution process, which is currently underway. It is being driven by the resolution professional managing that. We are in live discussions and engaged with the RP and COC. And, I would not like to again speculate beyond that, but it is an asset that we are keenly looking at.
Okay. One last question on what is the ROC you expect from the Bangalore assets when it is stabilized?
So, Samar, that's a speculation. What I can say is that start today, again, from what I understand it, and I'm bound by confidentiality, so on a public platform, I would refrain from giving any specific numbers on it. But, from a publicly available information that is there with us, it's a 100+ crore, EBITDA asset currently. What it can do or what ROCE it will have is again a function of what value it comes in, if it at all comes into Juniper, if he were to win the resolution process. So there are a lot of, steps between now and when the final decision of the RP is going to be done. When that happens, we will again share that with the investors.
Sorry, I mean the Bangalore asset we are currently coming up with the Marriott one and near the airport.
So from a ROCE perspective, okay, understood. So for our Bangalore asset in phase 1 and phase 2, the phase 1 has got the cost of land also built in. But if you were to look at it on a holistic manner of 508 keys and all-in cost for development, this would generate 15% plus ROCE. So it will definitely be, ROCE accretive for the balance sheet of Juniper.
Okay. There is one more question if there is time. So there are land parcels adjacent to Grand Hyatt Mumbai, and previously we were creating a new Hyatt there, and then there were some talks of commercial leasing. And what is the final, is there any definite or final plan we see on those land parcels?
See, these two assets next to Grand Hyatt are our prized possession, which do not get counted or reflected in our performance. But I can assure you that at this moment we have engaged top-class consultants to advise us of how to exploit these opportunities, either in hospitality or otherwise. So we still do not have a very clear decisions we have not taken, but these are being actively pursued as we talk. We will share with you more information on them once we finalize the usage of them and the project cost entailing on that.
Okay. Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone phone. Participants are also requested to kindly restrict your questions to 2 per person. We have the next question on the line of Raghav Malik from Jefferies. Please go ahead.
Yeah, hi. Thank you for the opportunity and congrats on a robust set of results. So firstly, just on the guidance that you gave of 9 to 10% sort of demand growth for the industry, where could we expect maybe, the Mumbai market to be in that, how much lower or in line with that range that we expected for us? Because, for the industry actually, because for us, I would say that, Grand Hyatt and the superb transformation you've done has brought about that big jump in occupancy. But in general, for like demand growth for Mumbai, are you seeing it track, where in that range maybe? If you could elaborate.
So the Bombay market remains extremely strong, right? With Fairmont opening up last year, the absorption has been very strong. We have not seen any occupancy dip. Occupancies remain steady, if not grown. Rates have grown further. So we do not see any kind of weakness in the Bombay market. I think this is only going to continue. Again, supply is still limited. There's nothing that is being planned to come in. Over the last 3 years, as I mentioned, one was the Fairmont, one was Aurika. All of them came. Aurika wasn't even in the luxury segment. And as a growing city, I think the demand will continue to outstrip the supply, and we are well positioned to take advantage of that.
So, yeah. Sorry, please go on.
No, I was just saying that, adding one more point, we have grown better than the concept like, we have for the past year plus in Mumbai. We've grown better than the concept in ARRs. And, going forward, we are embarking on those two strategies, right? We are pivoting to focusing on more on the high-paying segment, and plus we are also bridging the gap on the ARR vis-a-vis the number one in the concept. So there is expectation that we will continue to do better than the concept in Mumbai going forward as well.
Sure, understood. And just in terms of the occupancies, like a follow-up, in terms of occupancies for Grand Hyatt, now would it be like at the normalized level, or is there still scope, to increase it with the rooms coming back to market, you guys? Hello.
Sorry, are you talking about Grand Hyatt Bombay?
Yeah, Grand Hyatt Mumbai. So you guys have, renovated a bunch of rooms. So is it now that everything's back to the market, like from the perspective of the rooms coming back, is there still scope to grow occupancy, or will it now just be more in line with the market?
547 room asset, right? Occupancy does stabilize at 80 to 82%, right? So from that point of view, yes, there is some room for growth, but that's where it is. More up. If you're actually looking for upside, I think you have to look more from the rate point of view. I think the rates are still subdued. If you're going to go see the overall city rate, I think it's still much higher than ours. So I think that's where the revenue top line and the EBITDA will come through. For any incremental increase in rate, at this level, I think almost 80% will go down to the bottom line. So from that point, that's what you should be seeing.
Sure. Understood. I'll come back in the queue. Thank you.
Thank you. We have the next question from the line of Abhay Ketan from Axis Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. So my question is on the EBITDA side. So you've seen very strong growth and very sharp expansion in margins this year. We saw that in the previous quarter as well. While some of it can be attributed to the fact that there was renovation in the base year. But if you can help us in breaking down that how much of the renovation cost in the base and how much was because of low other expense. And within that also, in terms of employee cost also, we see that the total number of manpower has increased on a YOY basis. However, employee cost as percentage of revenue has actually fallen. So can you also explain that?
So I'll take the second one first. I think, we've added, the manpower primarily to augment the project team because we have large projects that are currently underway, and that will contribute to growth. Coming to your specific question, I think, of course, the rate of revenue growth is much higher than the rate of growth of the wages. And hence there's a, reduction on the percentage of revenue on the wage bill. And that is what is positive. That despite the growth in headcount, we are still maintaining, the overall wage cost as a percentage. On the question on the expansion of margins, we've always said that for a company like ours, normative margins have to be in the region of 40%. And I think this quarter has enabled us to get back to that 40%, normative performance. So it is not, something which is like a one-off. It is something which we needed to trend to a normative performance level, which we've done so. As far as last corresponding quarter of the last year, there was just one element of one time which was there, which was roughly around 3 crores of R&M. So if you have to do that math, I mean, you can add the 3 crores of R&M last quarter corresponding, which is not there in this particular quarter.
Okay, got it. Thanks. Very helpful. My second question is on the ARR growth that we have seen in this quarter for the luxury and the upper upscale segment. So on the luxury side, I understand Grand Hyatt has done slightly ahead of what the concept has done. But again, is that something, how much of that was driven by the fact that you had also renovations and therefore there'd be some natural uplift from that? So how much did that contribute to the growth? And secondly, even on the upper upscale segment, 13% growth is a very strong number. So can you highlight which cities are mostly corresponding, which particular assets are contributing more towards this high growth?
Sure. So, for Grand Hyatt, yes, I mean, and that is something which also I mentioned in my comment, that we are investing into assets to give a better product experience to the consumers. And it's not just limited to Grand Hyatt. So, but since you mentioned about Grand Hyatt, yeah, I mean, the investment that we did in Grand Hyatt is enabling us to capture and focus more on the transient and the high-paying group segments, and reduce our overall contract business, which is now in Grand Hyatt down to less than 6%. So that is one major, contributor to the ARR improvement. And I think, as Varun said, there is still a significant catch-up with respect to the concept that is required, and the headroom is still there in Mumbai. Going to the second question on the upper upscale, the key contributor there is Ahmedabad, which has seen, as I said, 17% plus, growth in ARR.
Thank you. This is very useful.
Thank you. We have the next question from the line of Hitesh Arora from Abacus. Please go ahead.
Yes. Thank you. Thank you for the opportunity. I just wanted to get a sense of what is the CapEx we are looking to do in FY27 and FY28. Some estimate would be helpful, please.
Yeah. So, just give me a second. I'll give you the exact numbers. Yeah. So we are investing, as I said, Kaziranga is the one which is getting under construction, and then you have Bengaluru itself, which will come in phase 2. So from FY27, the capex that we are projected to do is roughly around 274 crores, and in FY28 roughly 525 crores. This covers, the projects that we have disclosed, which is essentially Bengaluru phase 2, Kaziranga, and also Guwahati.
This capex, do you think we fund via debt, or do you think we need to raise more equity?
Yeah, from a sources perspective, right, Hitesh, we are sitting on roughly 200 plus crores of cash, and we are generating as gross cash roughly around 300 crores every year as we go forward. And so I think most of this will get funded through robust cash flows, and then on top of it, we also have significant headroom for debt if we were to take that decision, because we are right now on net bank debt to EBITDA, we are just at 1.3.
Sure. Fair enough. Understood. Thank you. We come back in the queue.
Thank you. We have the next question from the line of Lokesh Manik from Vallum Capital. Please go ahead.
Yes, hi. Thank you. My compliments to the team for the execution of the strategies outlined in the past few quarters. My first question was actually more broad and more from a 3 to 5 year perspective. Arun sir, where does Hyderabad sit in your entire strategy? That's the missing piece in the puzzle. Do you think so? And any outlook on that would be great if you're planning any properties out there.
See, I will tell you, Hyderabad is definitely on our radar and it's on a priority list. And we did engage on certain assets which I'm not able to share with you on an open platform. And we will continue to look for ready-built asset if there is any coming into the market, or even greenfield or brownfield opportunity in Hyderabad. This is definitely on our radar screen number 1.
And any development on the properties towards Navi Mumbai side, the second new airport that's coming?
See, Navi Mumbai per se, we have continue to look at the airport, the new airport of Navi Mumbai, and that is an opportunity which is in medium term really a good opportunity, and we are at this moment actively looking for opportunity in that vicinity.
Great. So I hope to hear some good Sure, sir. Hope to hear some good news on those two fronts, sir, going ahead.
Absolutely, sir. If you have anything in your portfolio that somebody is trying to sell, please do approach us.
Will do, sir. Thank you so much. That's it from my side.
Thank you. We have the next question from the line of Saurabh Gilda from JM Financial. Please go ahead.
Yeah. Hi. Congrats on a good set of numbers, and thanks for the opportunity. Just wanted to get a sense on how January has panned out and what sort of visibility do we have for Feb, March for Q4.
So as I said, we are seeing the basic variables continue to remain firm, and we are on track of achieving our guidance that we had set out for ourselves for the full FY26. So all the variables remain positive over the next 3 months.
Okay. So thanks.
To show healthy growth YOY even in this quarter.
So sure, sir. Thanks.
Thank you. We have the next question on the line of Juhi from Arihant Capital. Please go ahead.
Hello. Am I audible?
Yes, we can hear you.
Yeah. Thank you for the opportunity and congratulations for the number. My question is that it was noted that the company has utilized brought forward losses, which acted as tax shield against the current profit. So how many more quarters do you expect this tax benefit to support your bottom line?
Yeah. So, Juhi, we have today more than 1,000 crore of tax shield. And given our growth trajectory and very high, performance levels that we anticipate the company to achieve over the next few years, it should hold good for zero tax status for at least the next 3 years.
Okay, thank you.
Thank you. We have the next question from the line of Varun from Samarth Capital. Please go ahead.
In the last con call, you had mentioned that and given an update on the Hyatt Regency Mumbai that the construction is on track. Can you also update the status on the same?
Sorry, could you repeat that? I just lost you. Couldn't hear you clearly.
Can you hear me?
Yes, I can hear you now.
Yes, I was saying in the previous con call, sir, you had given an update that the Hyatt Regency Mumbai asset acquisition and construction is on track, and you would expect there's no change in the timelines as far as the operationalization of that asset is concerned. Can you share an update on the same? And also from a ROFO asset perspective, we do understand that you have clarified that there are timeline constraints around it, but is it broadly in line with the original timelines?
Well, as I said, Varun, I mean, from the perspective of Juniper today, when we have a credible update to share, we will be the first ones to share that on a very transparent basis. But, you have to appreciate these are individually listed companies, and that is, one of the key factors that I would want to defer that discussion to the time that we have something credible to share on those.
Got it. And overall, for the market as a whole, especially in Mumbai, how do you see the ARR trends over the next 3 to 4 years? How do you see the demand and supply trends shaping up, and what do you expect that to result in terms of ARR growth?
So the market will continue to remain very strong in Bombay in the next 3 to 5 years. As of now, if you go back in the market and do this, supply side is still going to be limited with 1, maybe 2 assets coming in the next 3 to 5 years. We believe the luxury segment will continue to perform well, and in terms of rate, I think there is probably still further upside on the rates as well. If you see the luxury segment is anywhere about 15,000 odd as per the numbers, I think this 15,000 still has upside. If you see in dollar terms, it's probably still $150 comparing it to other large cities in the region. So there is still upside there, and I believe the demand will remain very, very strong, and there is good upside on the average rates as well going forward.
Got it. And one last question. You mentioned that you're also evaluating acquisitions, and you shared about G-Start in Bangalore. From an acquisition perspective, how much in terms of, are there multiples that we are okay with in terms of premium to replacement cost, or we're looking for discount to replacement cost? Are there benchmarks that you have in mind for ROCE or multiples that you anchor yourself on as you think through acquisition and greenfield strategy?
Each asset has to be reviewed on its own merit. I don't think we have any sort of, I will not be able to share what our thresholds are, but each and every opportunity will be evaluated. If it is value accretive for Juniper, we will acquire that, and our prudent and capital allocation strategy remains intact.
Got it. Thank you.
Thank you.
Thank you. We have the next question from the line of Raghav Malik from Jefferies. Please go ahead.
Yeah, hi. Thanks again for the opportunity. So just wanted to ask you about the Delhi property. So for Andaz, given that, there's this big AI summit happening right now, is there like a very sharp jump that we can expect in ARRs, and what kind of occupancy would it be tracking at currently, maybe for the next week or this week?
So this is an ongoing trend for Delhi, right? Whether it's a large investor conference driven by Yashobhoomi or the AI or a foreign dignitary coming in, Delhi supply is also very limited if you actually want to look at it. Aerocity is sitting at 85-88% occupancy year round. There is leisure business coming into Delhi. So Delhi remains extremely strong, and it will continue to see global events happening on a regular basis. With the two large convention centers run by the government, the Bharat Mandapa and the Yashobhoomi, that will continue to drive. So you will find this month on month an event happening, and there will be spikes, and there will be a good trajectory. Sorry, go on.
And this is one of the reasons we are scouting for more properties in Delhi, both greenfield, brownfield, and we are actively looking at adding more properties in that micro market, along with definitely Mumbai, as mentioned earlier, Navi Mumbai, Bangalore, and Hyderabad.
Sure, sir. And for the Bangalore property, just on a maybe normalized pure set basis, like what is the average ARR that we can expect when normalized?
So, given the market there, and there are also current benchmarks for Marriott in that particular micro market, we believe this asset, the starting ARR could be north of 14,000.
North of 14,000. Okay. And sorry, if I can just squeeze one last question in. So for bit prima facie, but for FY29, there seems to be a very sharp increase in keys. So is there a very fixed timeline even for those 500 unnamed keys so far in terms of the kind of jump in keys that we'll be seeing? And would that could lead to...
Yeah, sorry, Raghav, I'm just cutting you. We are aggressively working on the brownfield and greenfield acquisitions. We believe that one asset itself, we are not looking at adding a bunch of 50 key assets, right? I mean, our ethos is to focus on big box assets. That is what really makes sense for us. And I think, even one asset potentially can fulfill that obligation.
And would it be right to assume that there could be a debt increase in that particular year, then a sharp increase just to make up for that?
If we do decide, if we do decide, and again, there are a lot of variables, as I said, our operating cash flows remain very strong. So it is also a function of what other things we are doing. But let's say hypothetically, if we keep the operating cash flows aside and if we were to leverage at that point in time, there would be a short spike in the leverage, but we would also even then make sure that we don't breach, the prudent gearing, EBITDA to debt ratio of 2.5 times.
Sure, sir. That's very clear. Thank you. Thank you so much.
Thank you. Ladies and gentlemen, in the interest of time, that was the last question for the day. I would now like to hand the conference over to the management for closing comments.
Thank you very much. I want to extend my sincere gratitude to all our stakeholders all people who were present on this call, our shareholders, partners, our employees, and most importantly, our guests, for their continued trust and support in Juniper Hotels. Together, we are navigating one of the most exciting phases of India's hospitality journey. Our vision remains clear: to redefine luxury hospitality in India while creating enduring value for all our stakeholders. Thank you very much.
Thank you. On behalf of Juniper Hotels Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.